Okay, let's unpack this. We are diving deep today into the recent Icahn Enterprises IEP Q3 2025 earnings call. And honestly, for anyone following the stock, this quarter was, well, a stunning and pretty necessary upside surprise.
Yeah, absolutely. After a really tough year, lots of scrutiny, this felt like management saying, okay, look at the numbers.
Exactly. Repairing credibility through execution. And the market definitely got that message. I mean, the shares were up nicely all day.
Yeah.
So our mission now is to look past just the stock pop, figure out what really drove this, the financials, the catalysts, and maybe more importantly, understand how they're shifting strategy using that, massive capital structure.
Right. Where are they pointing that battleship next?
Precisely. Let's kick off with the results snapshot because, wow, this was just a clean sweep against expectations. GAAP EPS landed at a pretty remarkable $1.49 per depositary unit.
Which is huge. The consensus was what, 17 cents?
Yeah, it's 17 cents. That's a $1.32 beat.
Yeah.
Just crushed it.
When you see that kind of beat, you know something significant shifted underneath. It's not just a little tweak.
And the revenue confirmed it too, right? $2.7 billion. The street was looking for closer to $2.04 billion. Comfortable beat there.
Comfortably. And the profit jump year over year, the adjusted EBITDA.
Huge. $383 million this quarter, compared to only $183 million back in Q3 24.
Almost double. So like you said, not just a good quarter, a statement quarter. Things look like they're stabilizing.
And crucially, amidst all this strength, they kept the distribution steady, 0.50 cents per quarter.
Which, given everything that's happened, maintaining that dividend is absolutely central for a lot of investors holding this. That sustainability signal matters.
Definitely. So stepping back then, what's the bigger story here? Financial repair.
I think that's exactly it. The narrative is portfolio recovery, financial repair. You saw it in the indicative net asset value, the NAV. That number, which gets watched so closely, it jumped by $567 million just in the quarter.
Okay, $567 million. Now, where did that come from? Doesn't just materialize.
No, it definitely doesn't. It was overwhelmingly driven by one segment, energy, specifically CVR Energy. Get this, consolidated adjusted EBITDA for energy was $625 million.
$625 million. Didn't they lose money in Q3 last year?
They did, a $35 million loss in Q3 24. So, do the math. That's nearly a 2/3 of $1 billion swing. It's massive.
Okay, so what happened at CVR? What flipped the switch?
The single biggest factor, the thing that really boosted NAV too, was the resolution of these small refinery exemptions, the SREs. These were pending from 2019 all the way through 2024 compliance years.
Right, the SREs. For listeners maybe not super deep in refinery regs, just frame that up. Why is resolving these worth so much?
Sure. So refiners like CVR usually have to either blend renewable fuels or buy these expensive compliance credits called RINs. It's a huge cost. If you don't get an exemption, that cost hits your books as a massive liability. Getting those multi-year SREs resolved, it just wiped a $488 million liability clean off CVR's balance sheet instantly.
Wow, $488 million.
Yeah.
Okay, so that regulatory overhang just vanished.
Pretty much. Overnight de-risking. And management sounded pretty hopeful, actually, about getting continued SRE grants going forward. They specifically mentioned their Wynwood refinery, believing it deserves 100% exemptions.
Got it. So that regulatory clarity, that's the bedrock for the quarter's performance. Okay, let's shift then. Past CVR. What about the other businesses they control? Are they starting to fine-tune operations there too?
Yeah, definitely seeing that, especially in automotive. Pretty aggressive management happening. Same-store service sales were up a solid 6%. That brought in another $21 million. And importantly, they're cleaning up the footprint. Closed 89 stores they saw as underperformers, really focusing the path for the ones that are left.
Okay, and that leads right into that interesting move they made after the quarter ended, shifting the owned real estate.
Right, transferring most of the properties out of the automotive segment and into the real estate segment.
Is that just moving deck chairs, or is there real value unlocked there?
Oh, I think it's genuine value unlock. Textbook activist move, really. It does a few things. First, the auto operating business looks cleaner, has a lower asset base, so you can see its actual performance better. Second, the real estate itself, which is valuable, can be managed separately, maybe financed better, maybe sold later, freeing up cash. It separates the operations from the hard assets.
Makes sense. Streamlining. Okay, let's pivot to pharma, the anti-obesity market. We know that's been tough. Where's the focus now?
Yeah, pharma EBITDA was down, and that competition was a big part of it. Generics hitting sales, including those obesity products. So the excitement, the real bet, has shifted entirely to their drug in development for pulmonary hypertension, or PH. They've even named the phase 2 trial. Transcendent.
Transcendent. Okay. High stakes.
Very high stakes, but potentially a very high reward. They're aiming to dose the first patient early next year, Q1 2026, looking for about 300 patients globally. And here's the kicker. Management stressed this could potentially be the first ever disease-modifying product for PH, not just treating symptoms.
Wow. That'd be huge. Obviously, a long way to go. Trials are risky.
Exactly. Years away, depends on the data. But that's the big swing they're taking in pharma.
So, energy stable, auto getting restructured, pharma taking a big shot, any lingering issues. Food packaging, I remember, had some headwinds.
That's right. Food packaging is still working through a pretty major restructuring. That's led to lower volumes, some manufacturing inefficiencies. Management basically said, expect that disruption to continue until the plan's fully done, probably Q2 2026. So still a bit of drag there for now.
Got it. Okay, let's switch gears to the investment portfolio. The activist side. Overall funds did okay, up about 5% ex hedges. Equester was a big winner, they said. But what really jumped out was this deep dive into the AI infrastructure thesis.
Yeah, they laid out a really clear, pretty concentrated bet centered on the electric utility AA. The thinking is simple. AI data centers need absolutely massive amounts of power, and AA is perfectly positioned to provide it.
And they had specific reasons, right? It wasn't just a feeling. They had criteria.
Exactly, not random. They said a winner needs 4 things. Right jurisdictions, right assets, enough scale, and the right management. And they argued AA ticks all those boxes. It operates in key states like Texas, Indiana, Oklahoma, big data center growth areas. And it's huge, market cap over $60 billion, so it has the scale to actually fund these giant projects.
And this AI power play isn't just AA, is it? They mentioned another one.
Right, Southwest Gas or SWX. They pointed out that after its separation, SWX has a, quote, best-in-class balance sheet, and analysts are forecasting pretty strong growth, like 14% compound annual growth in net income through 2029. What's driving that? Favorable regulation, plus potentially building out pipelines specifically for data centers popping up in northern Nevada. So, same theme.
Interesting. Then there was EchoStar. That's been a big winner for them already, right?
Huge winner. The whole idea there is the value of its spectrum assets, kind of an asymmetric bet. And you've seen deals with AT&T, with SpaceX that kind of highlight that hidden value. The stock ran up to around $75 by quarter end. So that thesis is definitely playing out.
Okay. And Caesars, they mentioned that one too. Sounded a bit more muted there.
Yeah, they acknowledge the recent performance hasn't been great, macro headwinds hitting Vegas maybe, but they said the core thesis is totally unchanged. They still see value in the owned real estate. They like the free cash flow going to buybacks, and they believe in the long-term growth of digital gaming iCasino. So they're sticking with it.
And then the big reveal, almost simultaneous with the call. The Monro filing, MNRO.
Yeah, the 13D filing. Showing a significant stake in Monro, they run about 1,100 auto service shops. This is really important.
Why the 13D specifically?
Because the 13D signals active intent. It means they plan to talk to management, maybe push for changes, maybe even seek control. It's not a passive investment like a 13G. It clearly marks a new activist campaign kicking off in that auto aftermarket space. And it connects directly back to the restructuring they just did in their own auto segment. They're ready to put capital to work externally now.
Okay, so let's try and connect this to the bigger picture now.
Yeah.
Capital structure, the activist DNA.
Well, first, the liquidity is still very strong. At the holding company level, they've got $3.44 billion in cash and invested funds. Plus, the subsidiaries have another $1.2 billion available in cash or revolver access. So, immense firepower.
$3.44 billion at the holdco alone. Wow.
Yeah. And management really leaned into their activism strategy. They talked about their advantages, the Icahn brand, their track record with proxy fights, and critically, using that permanent capital structure, that balance sheet strength to, and this is their phrase, tender for entire businesses. They're thinking big deals.
Right. But we should add the caveat, right? Returns haven't always been smooth. There's structural complexities, the short seller history. This strong Q3, driven a lot by that CVR fix. It feels like a necessary first step to rebuild confidence. Maybe not the final destination yet.
Oh, absolutely. I completely agree. This quarter delivered the proof points they needed. Clean numbers, stabilizing operations, that CVR resolution. It lays the groundwork. Now they can credibly go out and execute that next phase of activism. It was about restoring trust, really.
Okay, now for the part we always enjoy. Time for our outrageous but plausible trade idea. And let me be crystal clear, everyone. This is not financial advice. Just a thought experiment.
Purely conceptual, entertainment purposes only.
All right, so given IEP's renewed focus on auto aftermarket, they cleaned up their own shops, unlocked the real estate value, and now bam, this 13D in Monro. The trade idea is a levered long position in MNRO common stock.
Betting on what?
Betting on an acquisition premium. Essentially, betting that Icahn Enterprises makes a hostile bid or launches a tender offer for Monro.
Okay, walk through the rationale. Why is that plausible, even if outrageous?
Well, look at the pieces. IEP has the cash, right? That $3.44 billion we just talked about, planning to take a run at Monro. They explicitly said they can tender for entire businesses. They have the appetite, and they just finished restructuring their own auto segment. What's the logical next step to gain scale quickly in a space you now understand better? By a big established player like Monro. The 13D is the flare gun signal.
It connects the dots, definitely. They have the means, the mode of strategic consolidation, and they've shown the opportunity by taking the stake. It makes logical sense within their stated playbook.
Exactly. So to quickly recap the key takeaways from this IEP quarter. 1. The massive EPS and EBITDA beat. Huge credibility boost from the numbers. 2. That CVR Energy turnaround, driven by resolving the SREs. Wiped out $488 million in liabilities, stabilized NAV, crucial. And 3, the activist playbook is officially back in action. You see it with the Monro stake, the focus on scale, using that balance sheet.
Those are the core points, yeah.
Okay, but let me leave you, our listener, with one final provocative thought to chew on, building on what they said. Management seems really confident that their scale's a unique advantage, especially for funding huge infrastructure projects like the ones needed for AI that benefit AA. So the question is, with that $3.44 billion cash pile at the holding company, how likely is it that IEP targets another big utility or energy asset to really double down on that AI power generation theme?
That's definitely something to watch. Using that cash for another major energy infrastructure play fits the narrative perfectly.
Food for thought. Okay, that wraps up our deep dive into Icahn Enterprises Q3. Thanks for joining us. Remember, these are complex entities, markets are volatile. Always do your own research. We'll talk again soon.